Hi. Today we're breaking down the three vital economic metrics, including an unsung hero called mortgage spreads, that prove 6% mortgage rates are likely as good as it gets for the foreseeable future. So, the housing market revolves around a 10-year Treasury yield, which is driven by the Federal Reserve policy. This chart is the 10-year yield and the mortgage rate. What surprised a lot of people this year is we went into 2026 assuming we'll get 2-3 rate cuts, and the labor data improved. I think that's the number one thing. A lot of people think it's the conflict, the war itself, but because the labor data has improved, all rate cuts are off the table. The inflation is running hotter than what some people would like to see, and then honestly, the conflict happened, but oil prices have come down. Regardless of that, mortgage rates still stayed in the 6%. And the difference is that 2026 is the first year since 2022 where mortgage rates have not gone up above 7%. What drives the housing demand is lower yields and lower spreads, which is why this chart is so important. The fund rate is the target interest rate range set by the US Federal Reserve. According to Housing Wire's lead analyst, Olga, the history of mortgage rates getting below 5.75 and the federal fund rate trying to get to 3% is just not with us. So if you hear people waiting for rates to hit 5% or reading online that a massive recession is going to drop rates, that is simply a myth. Over the last few years, whenever rates dipped toward 6%, that was because the economy showed temporary weakness, not because the Fed made borrowing easier. The reality is, unless the Fed completely changes its policy, rates hovering near 6% is quite literally as good as it gets. Even hitting 5.75 in the future would require multiple rate cuts already priced in. Keep in mind that if it wasn't for COVID, we wouldn't have had a recession in 2020, and we would have had a 16-year expansion cycle. The unsung hero of the last 12 months of the housing market is mortgage spreads, the difference between the 10-year yield and the 30-year mortgage rate. A normal spread is around 1.6 to 1.8%. Yet back in 2023, it spiked above 3%, which pushed mortgage rates to 8%. According to Logan, the contraction of these spreads over the last 12 months is the number one reason our housing market has been stable, because spreads came down to almost normal, the volatility has compressed. We haven't had a lot of growth in the last year, but we also haven't had a lot of weakness in the last 12 months, and that's because it's the lowest mortgage rate curve since 2022. If mortgage spreads did not improve, and if we were at 2023 levels, we'd have rates near 8% today, according to Logan. 2024, 2025, we were over 7% most of the year. The spread we have now is also the reason why it's difficult for rates to go above 7. The worst is kind of over for us, even if the Fed gets more hawkish and hikes rates. Navigating this unique economic landscape, that takes strategy, not guesswork. So if you want to look at how these numbers translate directly into your purchasing power or your home equity, send me a message. I'm always here to be your sounding board. Thank you so much for watching, and see you next time.